Good day, investors. Qualcomm just dropped its third quarter fiscal 2026 earnings, and the results were mixed. Revenues and earnings came in close to prior guidance, but the company continues to face meaningful near-term headwinds in the handset business, while its diversification efforts keep gaining momentum. So in this video, we'll break down the earnings numbers, then look at the long-term fundamentals for the company. After that, we'll review some price targets, and finally, I'll give you my personal take on whether Qualcomm stock is a good investment opportunity right now. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. Thank you very much. Looking at the third quarter results, Qualcomm reported total revenues of $9.9 billion. GAAP EPS came in at $1.87, while non-GAAP EPS was $2.21. On the QCT side, revenues hit $8.5 billion, landing at the high end of guidance, with earnings before tax of $2.2 billion and a 26% margin. Combined automotive and IoT revenues reached $3.4 billion, up 28% year-over-year. Automotive alone has now delivered 23 consecutive quarters of double-digit growth. QTL contributed $1.3 billion in revenue, with a 69% EBT margin. On the capital return front, the company returned $2.3 billion to stockholders, including $1.4 billion in share repurchases and $1 billion in dividends. They also completed the acquisition of Modular Inc. to strengthen their software foundation for generative and agentic AI. Now, if we look at the key figures for the quarter, we can see a clear split between the handset business and the diversification segments. Non-GAAP revenues came in at $9.95 billion, down 4% from last year. Earnings before tax fell 24% to $2.69 billion, and non-GAAP EPS dropped 20% to $2.21. On the QCT side, total revenues were $8.5 billion, down 5%. Handsets declined 20% to $5.09 billion. Automotive surged 61% to $1.59 billion, while IoT grew 9% to $1.83 billion. QCT EBT margin compressed 4 points to 26%. QTL revenues were $1.28 billion, down 3%, with EBT margin at 69%. These figures show that Qualcomm had a mixed quarter. Soft handset demand dragged overall results lower, while automotive and IoT continued to deliver strong growth. Now, if we look at guidance, we can see that Qualcomm is expecting a sequential improvement in revenue, but margins will remain under pressure. For the fourth quarter, the company is guiding total revenues between $9.7 billion and $10.5 billion, and non-GAAP EPS in the range of $2.05 to $2.25. QCT revenues are expected between $8.4 billion and $9 billion, but the EBT margin is guided lower at 23% to 25%, reflecting higher input costs across the industry. QTL is guided at $1.2 billion to $1.4 billion, with margins of 68% to 72%. Management also noted that the semiconductor industry is seeing broad-based increases in input costs, including wafers, packaging, and memory. They are raising product prices to offset these costs, but the benefit will phase in gradually over time. Management also highlighted three key factors impacting both the third quarter results and the fourth quarter outlook. First, they estimate that QCT handset revenues from China OEMs bottomed in the third quarter and are expected to return to double-digit sequential growth in Q4. Second, the semiconductor industry is facing broad-based increases in input costs across wafers, packaging, memory, and other materials. Qualcomm is raising product prices to offset these higher costs and expects the benefit to gradually improve gross margins over time. Third, due to supply constraints, the company now expects a faster step down in Apple product revenues starting in the fourth quarter. Their modem share for the upcoming iPhone launch is expected to be materially lower than the previous estimate of 20%. All of these factors are already reflected in both the Q3 results and the Q4 guidance, which shows that the company is being transparent about the near-term challenges while still positioning for sequential improvement in the handset business. Now, one of the biggest near-term headwinds for Qualcomm is in Android handsets. Historically, QCT Android handset revenues grew at a solid 12% compound annual growth rate from 2020 to 2025. But in 2026, unprecedented increases in memory pricing and supply constraints are creating significant cyclical pressure across the global smartphone industry. As a result, Qualcomm now expects Android handset revenues to decline by roughly 20% year over year. That drop alone is estimated to reduce annual EPS by more than $1.50 compared to the prior year baseline. Looking ahead, non-handset revenue growth is set to become a major inflection point for Qualcomm. In 2026, non-handset revenues are expected to grow about 24%. In 2027, that growth is projected to accelerate sharply to 60% or more. Importantly, the year-over-year increase in non-handset revenue in 2027 alone is expected to fully replace the total Apple product revenues that Qualcomm is generating in 2026. This marks a significant step in the execution of their diversification strategy. Now let's zoom out and talk about the bigger picture, because Qualcomm's long-term story is getting a lot more interesting. Over the past 5 years, Qualcomm has doubled non-GAAP revenue and nearly tripled EPS. That track record supports the bigger diversification push. The key update from Investor Day, the 2029 non-handset revenue target was raised from $22 billion to $40 billion, roughly a 40% four-year compound annual growth rate. Data center is now the largest growth opportunity. The roadmap runs from connectivity in 2026 through custom silicon, AI accelerators, and CPUs by 2028. Together, these address a $1 trillion+ total addressable market by 2029, making data center one of the biggest growth drivers for Qualcomm. Qualcomm is also becoming the platform of choice for the automotive industry with Snapdragon Digital Chassis. Compute content per vehicle is growing roughly 8 times from Gen 3 in 2022 to Gen 5 in 2026. Serviceable content per car now ranges from $200 to $3,000, and the overall SAM is expected to grow at a 15% compound annual growth rate through 2029. Qualcomm's revenue is growing significantly faster than the market, driven by richer digital cockpits, more sensors, higher-level ADAS, and generative AI, making automotive another key growth driver for the company. IoT is another major growth engine for Qualcomm. They're targeting $14 billion plus in revenue by 2029, representing roughly a 20% compound annual growth rate from the $7 billion level in 2025. About $6 billion of that is expected to come from personal AI and compute, devices like smart glasses, mixed reality, earbuds, and PCs, where agentic AI is set to drive the next big inflection. The remaining $8 billion comes from industrial, networking, and robotics, where Qualcomm is positioned to lead the industry shift toward microprocessors, wireless connectivity, and on-device AI. Putting it all together, the Qualcomm investment case rests on 4 clear points. First, a more diversified revenue base spanning handsets, data center, automotive, and IoT. Second, they raised the 2029 non-handset revenue target from $22 billion to $40 billion. Third, management has confidence in scaling non-GAAP EPS above $18 by 2029. And fourth, they see a $100 billion plus annual revenue opportunity over the next 5 to 7 years as these growth vectors scale. This is the longer-term setup that goes well beyond any single quarter's results. So, after looking at the earnings and the long-term growth drivers for the company, let's look at the price targets from stock analysis data. According to 36 analysts polled by S&P Global, Qualcomm currently carries a consensus rating of hold. The average price target sits at $220.57, which implies about 42% upside from current levels. The range is quite wide. The lowest target is $100, representing roughly 36% downside, while the highest target is $314, pointing to more than 100% upside. The median target is slightly higher at $222.50. Overall, analysts see meaningful upside on average, but the wide dispersion shows there's still a fair amount of debate around the near-term risks versus the longer-term diversification story. Looking at where the stock stands right after earnings, Qualcomm closed at $155.68, down about 4.4% on the day. In after-hours trading, it moved lower still, around $146. The company currently carries a market cap of roughly $164 billion. Trailing 12-month revenue sits at $44.5 billion, up 5%, while net income came in at $9.9 billion. On a valuation basis, the stock is trading at about 17.8 times trailing earnings and 16.6 times forward earnings. The dividend yield is currently 2.4%, with an annual payout of $3.68 per share. The 52-week range has been wide, from about $122 on the low end to nearly $260 on the high. Analysts maintain a hold rating with an average price target of $220.57, implying roughly 42% upside from current levels. To wrap things up, I like the long-term opportunity at Qualcomm. The diversification into automotive, IoT, and especially data center is starting to show real traction, and the path toward $40 billion in non-handset revenue by 2029 is becoming clearer. That said, the short term still has challenges. Handset softness, higher memory costs, and a faster step down in Apple modem share are weighing on near-term results and margins. Even so, the valuation still offers upside if the company can successfully navigate the current cyclical headwinds and deliver on the accelerating non-handset growth expected in 2027 and beyond. At current levels, the risk-reward looks reasonable for investors willing to look past the next couple of quarters. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.